So, in a way, very easy to understand, and in a way, not so easy to understand. We'll be looking at some individual movers in a few moments, but certainly it's another day where traders are breathing a sigh of relief, I think, with everything that was going on, including the triple witching. There wasn't too much damage done, let's put it that way.
No, not at the end. Clearly, a little sign of volatility when you look at the closing numbers there for the Dow, the S&P, and the NASDAQ. Little change for the S&P 500 at 47.18. The Dow Industrials gaining 57 points to 37,305. And the NASDAQ Composite adding about 1/3 of 1%. Remember, these are indexes, especially for the NASDAQ 100, the Dow and the S&P, that are at or near record highs already.
Yeah, I got to tell you, I was going back and looking at just the gains that we've seen on the S&P 500 since September. We're up, Vonnie, more than 14%, since October, since late October, October 27th, more than 14% on the S&P 500. I think this rally caught a lot of people off guard, and that's a very big move in a very short period of time.
Certainly is, and if you look at group ranked returns, you'll see that there are definitely as many groups higher as there are lower today, and lower by a startling amount in some cases. So, for example, the alternative carriers index up 8%. We have hotel and residential REITs up through more than 3.5%, whereas you have the office REITs down 3%. So there's a huge amount of dispersion in this market, and it's just fascinating to watch because we obviously got plenty of data too, including the Empire manufacturing data, which was disappointing and would have impacted some of these stocks.
All right, well, speaking of stocks that were affected today, let's take a look at some of the gainers on the day today. No shortage of these to keep an eye on. Shares at Costco actually hit an all-time high today, closing higher by more than 4.4%. Shares closing up $28. This after the company announced a special dividend of $15 a share. This is the company reported a beat in profit expectations for the fourth consecutive quarter. The company has shown quite a bit of resilience, especially when you compare it to Sam's Club, which is owned by Walmart. They struck a cautious tone when they reported earnings last month. Costco, by the way, up more than 40% so far this year. And then also taking a look at shares of Intel, rising today to a 52-week high, finishing the day higher by a little more than 2%, though earlier in the day it was a little bit higher. The company took the wraps off of new chips for PCs and data centers. Intel looking to break into hardware for AI. We did see in the wake of this unveiling, Bank of America Global Research raising its recommendation on Intel from underperform to neutral. And finally, how about a little M&A news on this Friday afternoon to get a stock moving higher? Shares of DocuSign surged this afternoon after the Wall Street Journal reported that the company was considering a sale, closing higher by more than 12.4%. The Journal reporting, citing unidentified people familiar with the situation, that DocuSign is working with advisors to explore a leveraged buyout, though the talks are in early stages. So there's a little bit of M&A happening here. Potentially.
I'll grab some of the decliners here, Tim. So first off, I'm going to look at Scholastic. So shares, actually, if you look at this ticker symbol SCHL, down close to 12%, so it's its worst day since September 22nd of earlier this year. This is a publisher of children's books, cutting it adjusted EBITDA forecast for the full year. So it did note that there were challenges in the retail market. Another stock I'm keeping a close eye on, Exelon. So this is among the biggest decliners in both the S&P 500 as well as the NASDAQ 100. That stock down more than 6%. It's actually just its worst day since yesterday, but extending those declines. Apparently, power utilities in Illinois were hit hard because there were diverse decisions by state regulators actually in the middle of yesterday. So that did prompt Wall Street downgrades. So you have Exelon, it owns Chicago area utility companies, especially ComEd as well. And so it did cut neutral securities and to inline from outperform if you are looking at Evercore. Another stock I'm keeping an eye on. Lastly, though, Quantex, NX is the ticker symbol on this, down about 11%, worst day since March 10th. So that was a while ago, and that was in the midst of what was happening with the regional bank crisis. But you are seeing that stock pressured. It just only has a market cap of around $1 billion, but it did reverse prior session gains after the company did report EPS above estimates and sales in line with estimates, Scarlett.
All right, let's take a look at the fixed income space and treasuries, you do have some buying at the long end of the curve. So yields on the 10-year, 20-year, and 30-year coming down. And in fact, the yield on the 30-year dipped below 4%. So, that is a headline that we can't repeat often enough, given the mammoth moves that we've seen this week on the heels of the Fed pivot. On the 2-year yield, you're looking at yields move up by 5 basis points to 4.44%. They've been all over the place as investors try to digest what happens next and how they should position for an eventual rate cut.
Yeah, and a 10-year yield that's at 3.9092 now. I mean, just a phenomenal move from just not even a month ago, basically 6 weeks ago, maybe.
Yeah.
Highs above 520 and so on for the 2-year, and now we're, like you say, Scarlett, right down at 444, an 80 basis point move, and that's just in the last week.
That's just in the last week. So it raises the question how investors are positioned for the new year.
Yeah.
I mean, I know that there's you mentioned, Tim, that people are taken by surprise, and you're certainly seeing that in the price action right now. But to what extent have they already positioned for 2024? Is that going to take up a lot of next week? And given the thin trading volumes, you might see some exaggerated moves.
One thing that we've been trying to think about is what happens between now and the end of the year, given that we've heard from a lot of Fed officials. We don't hear from the Fed formally between now and the end of January, or now and then the next Fed meeting at the end of January. There are still some companies reporting earnings over the next week, believe it or not. We got FedEx coming next week. We got Nike coming next week. So potentially there could be, some catalyst there. At the same time, I think, people are starting to go on vacation. People are starting to wrap presents and get ready for the end of the year. So I don't see too many catalysts apart from earnings, Jess.
One thing I'm keeping a close eye on, so this is a particular indicator. We've talked a lot about this Santa Claus rally. Actually, this is technically based and defined by the Stock Traders Almanac. It's the last 5 trading days of the year, first 2 of the new year. And Jeff Hirsch over there, the reason he watches that closely to see whether or not stocks end up bucking that trend, but typically over that 7-session span, going back actually to around the 1970s, the S&P 500 gains about 1.3% during that time period. So if the stocks buck that trend, that usually isn't necessarily a good sign, but that's something that some traders keeping their eye on, even though things are a little bit lighter on the calendar next week.
Yeah, I mean, there are still 2 weeks left, though, in the month, right? So perhaps you wouldn't want to be, missing out on some of those basis points that might come or may not come for the rest of the year. But yeah, if you had been in some of the indexes this year, you would have done phenomenally well, right? I mean, the NASDAQ back up more than 50% since the beginning of the year, and the S&P, as we've been saying, close to half that. It's up more than 23% for the year to date.
You just had to have been in the beginning of the year and not touched anything throughout all the trials and tribulations of the year. Forget the regional banking crisis, or
joined like after the October sell-off.
Right. that would have worked out nicely.
Almost the same.
Easier said than done, right? Hindsight is 2020,
That's
and that's
right.
why John Authors each year writes about Hindsight Capital. It's the hedge fund that is a time machine and can look backwards and make the perfect decision. So I'm looking forward to that.
I'm going all in on Hindsight Capital.
I think that's a good trade. Hey, you guys have a good weekend. That is going to do it for our Beyond the Bell coverage, our cross-platform coverage of the market here on Bloomberg Television and Radio, Bloomberg Originals, and on YouTube. Catch us on Monday, same time, same place. Have a great weekend, everyone.